There are not many industries that are as hated and misunderstood as investment banking, and it's easy to see why. Investment banks aren't banks, and they don't usually invest in anything either. So what the f do these guys actually do?
Unlike other firms in financial services, these Wall Street banks...
Goldman Sachs CEO David Solomon addressing concerns over his junior employees' workload.
Big talent war, there were big bonuses.
The issue of work-life balance is being brought up by first-year employees at Goldman Sachs.
The average salary for a first-year investment banking analyst at Goldman Sachs is $123,000 a year, and the median bonus received on top of that is $80,000 a year. An analyst performing at the top of their cohort can work their way up to associate, VP, and then managing director in around 10 years. MDs doing their job well can make a couple $1,000,000 a year from base plus bonus. A seven-figure salary before 30 is why so many people want to become investment bankers, even if they don't know what the job involves, and that can be a huge mistake. A survey of first-year Goldman Sachs analysts brought working conditions at these banks into the spotlight. The average analyst reported working 95 hours a week and getting less than 5 hours of sleep at night.
If your pain tolerance isn't high enough and you can't survive 100-hour work weeks, then perhaps you don't get to the next level of associate and so on, and hopefully climb that ladder.
Individuals reported showering once a week, too afraid to leave their desks because they would be shouted at by their superiors. This survey was completed by first-year analysts on first-year analysts. So as someone who has gone through this myself, I can tell you that the hours are real, but this report is a bit dramatic in my experience. So what tasks are these smelly analysts completing in their 95-hour weeks? The role of an investment bank is to link up investors and companies seeking their investment. The name investment bank makes a lot more sense when you think of a bank as a middleman. The word bank comes from the old Italian word banco, which means bench, like the bench that merchants sat on in market squares. A blood bank takes blood from donors and gives it to people who are sick and injured. A food bank takes food from donors and gives it to the hungry, and a money bank takes money from depositors and gives it to borrowers. An investment bank is just a middleman between investors and investment opportunities. To make matters more confusing, some of the biggest investment banks like Goldman have all diversified just beyond investment banking services.
I'm sorry, I don't understand.
Goldman now has 4 primary divisions. It has a property asset management division where the bank uses its own money to invest in the markets like a hedge fund. Its second division is regular investing and lending like any normal bank, further adding to the confusion between a bank and an investment bank. Its third division is institutional financial services. These guys provide coverage to investment funds with margin loans and trade executions. You can think of this like a Robinhood account for the biggest investors in the world. If you have ever watched the show Industry, institutional financial services is what most of the plot is focused around, not investment banking. To a layman, these 3 divisions might all look like different roles for investment bankers, but they aren't. Goldman's 4th division is just for investment banking that is kept totally separate from the rest of the bank's operations. There are also smaller firms in the industry, often called bespoke or boutique firms, that just do investment banking.
They have significantly leaner operations. That means they don't have consumer arms, it's unlikely they have robust wealth management arms, and they don't do any lending.
But alright, what does that actually involve? The actual tasks completed by the people working in the investment banking divisions of banks like Goldman or a boutique investment bank are a lot less sexy than Hollywood would have you believe. It's a lot more Excel and PowerPoint than 6-screen Bloomberg terminals and high-octane sales calls.
It's my own fault for using PowerPoint. PowerPoint is boring.
An investment banker is all about putting deals together, a lot like a real estate agent, but for companies instead of condos. The first step in putting a deal together is finding a client. Most of the time, the clients I worked with were investors or founders looking to sell their company or equity. This is called a sell-side engagement. We'd create lists of potential buyers of their company when pitching to represent them on a sale. These buyers fall into 2 categories: strategic buyers and financial buyers. Financial buyers are just looking for a good return. These clients will be private equity funds, hedge funds, or family offices that want exposure to a company that is not publicly listed. Strategic buyers are other companies that want to buy a competitor or a company above them or below them in a supply chain. Sometimes we were hired by a company to help buy another company in a strategic acquisition. This is called a buy-side engagement. One of the buy-side deals I worked on in my time was helping a publicly traded company acquire another private company that doubled their size.
Well, that's very interesting.
The final type of deal I worked on are strategic advisory deals, where an investment banker will evaluate a company to help them achieve strategic goals. One client that I dealt with wanted to sell $200 million worth of equity in his company to invest more broadly. My team was able to conduct strategic analysis and found that instead of selling his shares, the company could get a loan, pay it out through a dividend, and get his $200 million without selling his company. The company itself would then pay down the loan. This is called a dividend recapitalization. As an analyst or an associate, you will have very little to do with step 1, which is sourcing these deals anyway. If you are lucky, you might be invited to a conference or networking event by your MD or VP, who are the senior employees responsible for securing the business. For at least your first 5 years in the job, your work will really start at step 2. So it's time to learn how money works to find out what you would actually do if you became an investment banker and you were just handed your first deal to work on. This week's lesson was sponsored by Brilliant. Embarking on an investment banking career begins by acquiring a strong foundation in finance, which encompasses extensive mathematical knowledge, risk evaluation, and probabilistic analysis. Brilliant provides an excellent course to kickstart your journey. Their Math for Quantitative Finance course helps you to grasp the mathematics necessary to navigate the complexities of the financial markets. This course is a fantastic starting point for anyone interested in finance. I wish I had access to it when launching my own career. If finance isn't your preferred field, Brilliant still has you covered. Their platform includes a range of subjects such as computer science. With the rapid advancements in AI, understanding its fundamental concepts is crucial. Studying with Brilliant promotes interactive learning and allows you to apply your newly acquired knowledge, resulting in a more effective retention of information. Brilliant has successfully turned education into an enjoyable pursuit. Instead of viewing it as a burdensome school assignment, you can eagerly dive into the world of learning with just a few clicks on your device. Whether you're seeking new perspectives or simply aiming to maintain a nimble mind, Brilliant is here for you. Their engaging, hands-on approach to learning enables you to remain curious and well-informed. To get Brilliant for free for 30 days, go to brilliant.org/howmanyworks or click the link in the description, and the first 200 of you will get 20% off Brilliant's annual premium subscription. Investment banking clients will always field offers from multiple firms to see who they think will get them the best price for their business. Once an MD has made contact with a potential client through their social or professional network, they will try to convince the client's management team to hand over their financials so that they can work on a pitch deck. This is when the associates and analysts will get to work. A pitch deck is a 20 to 30 page PowerPoint talking about how much the investment banking team knows about the company and its industry. A pitch deck will also include information about the team at the investment bank that will be handling the potential deal, how long they think it will take, who the potential buyers would be, and most importantly for the client, how much they think they can get for the company based on market analysis and the company's provided financials. A lot of time is spent making pitch decks that are rejected by a client that decides to go with another investment bank or not proceed at all.
I'm so tired!
If your team does win the pitch, then work starts on building out the marketing materials for the company to give to potential buyers or investors called a SIP, or confidential investment presentation. At this point in the process, the company will open up almost all of their information to the banking team to put together this packet. The final document will be about 50 to 130 pages in length and will contain a story about the company, what they are trying to do alongside the hard data like organizational structures, products, patents, financials, locations, and market research. All of this information goes into a data room that is constantly updated during the sale process. In the old days, this would be an actual secure room at the investment bank filled with boxes of documents. Now, banks receive and store documents virtually on programs like DataSite and Intralinks, which are like extremely secure and expensive alternatives to Google Drive or Dropbox. Another important piece of information that will be included in the confidential information presentation is the reason why the company is raising money. Companies can raise money for 2 reasons. Reason 1 is to invest into the company and expand operations. Bankers will call this seeking growth equity. To achieve this, the company will issue new shares and let the investment bankers sell them to qualified purchasers. Creating more shares dilutes the ownership stake of existing investors in the business, so it's important to them that the money is used to make the business more valuable than the amount of their shares were diluted by. If someone went from owning 10% of the company to 5% of the company after an equity funding round that doubled the number of shares, then the business needs to at least double in value for them to be happy with that result. Reason number 2 that companies raise money is to pay out existing shareholders. Bankers call this a buyout or secondary offering. This one is more straightforward. If a founder or early stage investor wants to cash out of a company they have built up, they will sell the shares to a new investor that wants to buy the company as a long-term hold or as a strategic investment, like how Google bought YouTube. No new shares are created, usually, and the money raised doesn't go to the business, it goes to the people selling their shares. The reason that the company is raising capital and everything else that the investment team gathers at this stage of the process is highly sensitive and potentially damaging if it falls into the wrong hands. Part of the job of a good investment banking team is to make sure that the confidential information presentation is shown to only those that have the highest probability of making a competitive offer. Putting together a SIP takes a long time and is incredibly high-pressure work. The information presented in these reports make or break billion-dollar deals, and if something is inaccurate, the investment bank could be liable for the damages caused by the reported inaccuracy. An investment banking team on a deal is usually made up of one MD, one VP, one associate, and one analyst. Exceptionally large or complicated deals can have multiple associates and analysts, but clients and bank management prefer fewer points of contact, and deals just operate better when there are less people doing the same thing. Once the team has finished producing the SIP and management is satisfied that there is not incongruent information, it is distributed to the buyers that the banking team and the client have agreed on. There are usually 80+ buyers on this list, and the team's job then becomes fielding calls from these buyers to clear up details about the deal. These calls are stressful because you are talking to people that expect you to have perfect answers to hard questions about 130-page technical documents on the spot. Oh, and your MD or VP is usually on the call as well. You also have to sell the client's company without saying anything misleading that could be used to sue the investment bank or later damage their reputation. The first stage marketing campaign for a deal can take up to 3 months, and during that time, the investment banking team will whittle the list of potential buyers down to 20 or less. From those 20 buyers, a good result is having 5 or more present further interest. At that point, they will be given further access to the data room and send out teams to meet management and tour facilities. From those 5, usually 3 will provide a letter of intent, or LOI, with an offer outlining the basic terms of the deal and the price that they will pay. If the client accepts the buyer's offer, the deal then moves forward to due diligence. During the due diligence phase, the investment banking team will work with the client's lawyers and the buyer's lawyers, as well as a variety of other third-party providers, to go through a checklist of common problems and regular things that a business needs to have. For example, accounting firms will come in and review the financial statements to make sure that they are in line with what the company provided. The buyers and their teams will look at personnel charts, existing loans and liens, tax documents, and any ongoing legal problems. If they find any problems, the investment bankers need to be able to provide a solution quickly or risk losing the deal. If due diligence goes well, the buyer will then draft a purchase agreement using the initial letter of intent as a guide. The purchase agreement document is normally 60 pages long and contains a long list of terms and conditions, as well as a variety of other things like non-competes. These terms usually take a month to debate to work out, but once everybody is happy, a date is set for the deal to close and the money to be wired. Only at this point does the investment bank get paid their fee by the seller. The team will also help the buyer with mundane tasks like handing over the keys and arranging account access in the case of an acquisition. The new buyer needs to ensure that the staff is still getting paid and the business still open the next day, so the banking team needs to make sure this is all taken care of. This whole process from beginning to end can take half a year, and any little problem along the way can put an end to the whole deal. The clients selling their company have often not done anything like it before and will be very nervous the entire way. They will also expect someone from the team to be available at any hour of the day, as will potential buyers once they get involved. One wrong piece of information and thousands of hours of phone calls and hundreds of pages of documents can end your career. And if all of this wasn't stressful enough, an investment banking analyst is typically working on 4 to 6 deals at a time. Analysts that last past their first year are not partying or doing any of the other crazy stuff you see on TV. They are spending their time working or catching up on sleep and not much else. It's a grind that nobody can do for long. Most firms have an up or out recruitment policy where if you aren't promoted to associate within 2 to 3 years, you are fired, and the same with associate to VP within 5 years. The work of MDs and VPs is much more about finding business at networking events and engaging potential clients. The workload is much less intense and the pay is better, but some of these bankers spend a lot of their salary on maintaining multiple country club memberships just to get access to clients. Most investment banking analysts don't stay at investment banks. They get 2 to 5 years of experience working on deals and then transition into senior company management or private equity. The skills, experience, and connections they make at their time at an investment bank make them valuable hires for any company. From my personal experience in investment banking, I don't think investment banks are the evil entities they're portrayed to be in the news. But if you want to know my take on something I haven't had experience in, but will totally buy the sensationalized takes, then go and watch my video on how Saudi Arabia and hedge funds are the evil entities literally sucking America dry of our scarcest resource. Thanks again to Brilliant for making it possible for everybody to keep on learning how money works.